There's extreme fear, and there are some reasons, understand that. I believe the market, when we look back, maybe at the end of this year, is going to be characterized as climbing a wall of worry.
Extreme fear. But what does Tom Lee think about that?
Still in the camp that I think we're making our bottom this month for the equity market.
A bottom call. Right now. In the middle of all of this. Here's what's happening. March 31st marks the end of the first quarter. Tom Lee is calling a bottom. Cathie Wood sees a wall of worry being built in real time. And right now, the window for Nvidia holders to act is closing fast. There are 3 specific signals you need to understand before that deadline hits. Geopolitical pressure, energy price spikes, and a private credit system showing cracks. It's enough to make even seasoned investors nervous. But here's where it gets interesting. Because 2 of the most data-driven voices in finance are not running scared right now.
This is a really good time to pick up on stocks that might be more volatile. Volatility in our world it does not measure risk as much as it measures uncertainty. And we are not in an AI hype cycle. And we think it has miles to go.
Not a hype cycle. Miles to go. So what does that mean specifically for Nvidia holders before March 31st? Let's get into the 3 signals. That's signal number 1, and it comes from the macro picture that most retail investors are completely misreading right now. When global growth fears rise, capital doesn't disappear, it relocates. It moves toward markets and sectors that can grow regardless of what oil prices do, regardless of geopolitical tension, regardless of what the Federal Reserve says next. Right now, that destination is the United States technology sector. Specifically, the companies building and powering the artificial intelligence infrastructure that the entire world wants access to. Companies like Nvidia, this is the counterintuitive part, the same macro fears that are shaking retail investors out of their positions are actually driving institutional money toward exactly the kind of growth stocks that Nvidia represents. Higher oil prices slow global industrial economies, but they don't slow software. They don't slow data centers. They don't slow the demand for the chips that run artificial intelligence models. If anything, when the rest of the world slows down, the premium on growth goes up. And Nvidia sits at the very center of that trade. And here's something most people miss entirely. The United States stock market is not just a market, it's the world's primary growth index. When global investors want exposure to companies that are expanding revenues, expanding margins, and building the infrastructure of the next decade, they buy American technology stocks. That's not sentiment, that's a structural reality that has been true for years, and it becomes even more true when everywhere else looks uncertain. The fear driving people away from Nvidia right now is the same fear that is quietly pushing institutional capital back toward it.
Private credit's been a problem for some time, so I think it has been increasingly revealing, as Jamie Dimon said, more cockroaches. I do think it's probably not as systematic as we might fear. I know.
That brings us to signal number 2, and this is the one that's creating the most noise right now. Private credit stress is real. The cracks are visible. Tom Lee is not dismissing it, but he's drawing a very specific and important line. This is not 2008. In 2008, the entire financial system was connected through mortgage-backed securities that nobody fully understood. When one domino fell, they all fell. What's happening today in private credit is more contained. Painful for the institutions directly exposed, but not a trapdoor that pulls the entire market down with it. And then he said something that cuts straight through the noise.
But also, things that look like credit stress aren't really signaling like they did in 2008. So I think it's hurting financials right now, but I don't think it's a broader problem for the market or the economy.
That's the line that matters. Financials are hurting. He's not pretending otherwise. But the damage is contained. It's not spreading into the broader economy the way it did during the financial crisis. The wiring is different. The size is different. And for Nvidia holders trying to decide what to do before March 31st, that distinction is everything. Because if private credit stress were truly systemic, if it were 2008 all over again, then no stock would be safe, and this conversation would be very different, but it's not. and that changes the entire risk calculation.
Volatility in our world it does not measure risk as much as it measures uncertainty. And I think the new technology is evolving today, and the way we do, ARC does its research on these technologies.
Now here's the question you've been waiting for, and I want to come back to it, because the answer ties directly into signal number 3. There are actually 2 reasons why March 31st is the hard deadline. One mechanical, one narrative. And most people only ever think about one of them. The first reason is mechanical. Quarter end repositioning is real. Institutions that are underwater on Nvidia heading into March 31st face pressure to either average down or reduce exposure before they report. That selling pressure, if it materializes, creates exactly the kind of volatility that shakes out retail holders right before the recovery begins. It has happened before, it is happening now. The second reason is narrative. After March 31st, the conversation shifts entirely to first quarter earnings. Nvidia's numbers will tell the market whether the artificial intelligence infrastructure build-out is still accelerating, or whether the spending that drove Nvidia's explosive growth over the past 2 years is starting to slow. That earnings moment will either validate everything Tom Lee and Cathie Wood are saying right now, or it will force a much harder conversation. And here's what makes that earnings report so significant. The expectations are already high. When a stock has risen as much as Nvidia has, the market doesn't just expect good numbers, it expects extraordinary ones. Any sign of slowing demand, any cautious guidance, any hint that major customers are pulling back on chip orders, and the reaction will be swift. That's the knife's edge Nvidia is walking right now. Which brings us to signal number 3. And this is the most important one.
Is a technology revolution. And we are not in an AI hype cycle. And we think it has miles to go.
Miles to go. That's the entire thesis in 4 words. The demand for artificial intelligence computing power is not slowing down. The race between American and Chinese technology companies is accelerating it. Every major cloud provider is still expanding data center capacity. Every new model that gets released requires more chips to train and more chips to run. Nvidia sits at the center of all of it, and the 2 most convicted investors in the room are both pointing in the same direction. Cathie Wood's team doesn't just look at price charts, they study how technologies scale, they track adoption curves, they model what happens when a platform technology moves from early adoption into mainstream infrastructure. And every signal they are tracking right now says the same thing. This is still early. The companies at the center of this shift have not come close to seeing the full benefit of what's being built. The final warning for Nvidia holders before March 31st is this: the next 2 weeks are going to feel uncomfortable. There will be headlines that make you want to sell. There will be days where the stock moves in ways that feel completely irrational. That is the wall of worry being built in real time. The question isn't whether the wall is real, it is. The question is whether you're going to let it push you out of a position right before the market climbs over it. Tom Lee thinks the bottom is this month. Cathie Wood thinks the fear in the market today is the mirror image of the irrational confidence she saw at the top of the dot-com bubble. Both of them are still in. Both of them are still building. The clock is running. March 31st is closer than it looks.